What? And we're live. And you know something? I bet you. And we're live. I bet you. This is something you've never seen on a LinkedIn Live episode before. Hey, I'm Mitch. If we haven't met yet, I'm a financial advisor with the wealth management firm, ClientFirst Strategy. Thank you so much for joining me on a special Halloween edition of my live presentation. And we're going to talk about 5 scary mistakes that you could possibly make with your investing. And remember, everyone makes mistakes. The key is not to make so many mistakes that it actually hurts your long-term ability to retire in the lifestyle that you are accustomed to. So let me get started by saying a couple of quick announcements. First of all, okay, I'm looking over here because that's where my screen is, so I could just tell that I am all in the screen. Just got my new mic set up going here. Thank you very much. I am excited about this. I'm loving LinkedIn Live, and I'm going to see if I could watch this live. So here we go. Okay, you see that I'm watching it live as well. This way I can see the comments, who's joining me. If you're watching this live, let me know where you're watching from. Leave me a comment. Ask me a question. We're talking about investing mistakes, so you might have a question about investing or investing mistakes. We could go to investing right. Whatever you want, ask away. This is a good time to do it. If you're watching this in the replay, go ahead and comment, ask questions, give a thumbs up as much as you want, as if you were watching the live version, because I'm going to be checking this, and I promise you I will get back to you. I will reply to you. I would love to hear from you. I think the interaction here is, to me, the funnest part of going live and having these live streams. So we are live, and what I want to tell you about is the 5 big investing mistakes that investors are known to make. Again, thumbs up if you will, and if you have a question, ask me. I'll be checking my social media profile every now and then to make sure I get to you. If you are on the Long Island Railroad commuting home, definitely I hope this makes your trip a little bit more fun. If you're still in your office, you're watching this, check it out. I'm really excited that you're here. And what else could I say? So investing mistakes. It's a given that you'll make investing mistakes along the way. That's life. Everybody makes investing mistakes. It's really not something you can avoid, but learning from your mistakes, like every other kind of mistake in life, really means that you're learning something. Because, I've heard this expression many times, we learn more from failure than from success, or another way to put it is failure is a great teacher. But we're talking about your hard-earned money, your investment dollars. So if you had a few basic tips to get started, and even if you are an experienced investor, believe me, experienced investors make plenty of investing mistakes too. In fact, experienced investors become so experienced and so advanced sometimes that they forget about the mistakes to avoid when they were beginners. So even experienced investors do need an occasional reminder. Again, if you're just joining us now, we are watching the Halloween edition of my live stream to teach you about 5 common investing mistakes that I would like to help you avoid if we have some time. I even have a bonus mistake that people make. So let's get into it. I've got some notes right here. The first one, okay, is number 1. Investing mistake number 1, okay? We could talk about this one for a whole video. Investing mistake number 1 is a lack of diversification. Now, I don't have to tell you, well, maybe I do have to tell you. It depends on your level of experience. But diversification does not guarantee you against a loss in your portfolio. If we're in a generally down stock market, a bear market, a market correction, your account's going to go down with it if you're invested in the stock market. Diversification is a strategy, a method that we use to help mitigate overall risk. So in case one of your positions goes down a lot, one of your stocks or one of your funds goes down a lot, hopefully you'll have the others to help, buck up your account a little. So some positions in your investment portfolio go up, some go down, and vice versa. And when you have diversification, you get a little bit smoother of a ride. We call that lower volatility, potentially lower volatility. And the thinking is eventually your assets should do well over time. It's just that along the way, your assets will do poorly and will do well at different times. So that's what diversification is for. So let's say somebody has an index fund, let's say the S&P 500. Now, just so you know, you cannot invest directly into an index, but you could invest in an ETF or a mutual fund or some other product that mimics or tracks an index, okay? The S&P is about 25% tech stocks. So let's say you decide, hey, I want to invest in ETFs, exchange traded funds or mutual funds that are doing really well, or even just stocks that are doing really well. So you buy the S&P 100 index fund, and let's say you buy, ETF that tracks the S&P 100 index, okay? And you buy a few of these really well-performing exchange traded funds or mutual funds. The problem is when you look at these, the other ones you buy are also heavily tilted into technology. And if you look at the top 10 positions, you'll find Apple, Microsoft, you'll find Amazon, you'll find a lot of the big winners this year. So what you're really doing often is you're buying or investing in the same thing over and over and over. That's not really creating diversification. The way to create diversification that I teach to my clients that I want to share with you is this. Think in terms of if you have a mutual fund or an exchange traded fund and it's a large cap ETF. So let's say S&P 500 or S&P 100 type stocks. The next thing you would buy maybe is a small cap ETF because that would include smaller companies which would not be big enough to make it in the into the S&P 500. Okay, so that's how you have diversification because the two investments you have would have very different kinds of stocks. And then you can add a mid-cap fund and maybe a fixed income fund, okay, and an international fund. And this way you're not buying funds all with the same stocks. That is one way to potentially achieve broad diversification. Okay, so enough with diversification. Let's go on to the next one. The next one is, as you may have already guessed, is number two. Aptly said. Number two, right? That's pretty original, right? Number two, next one. Okay, so don't go by investing tips. I don't want you to go by investing tips from your friends. I don't want you to go by investing tips from somebody on TV. And I don't want you to go by investing tips from professional financial advisors. Okay, I don't give people tips. The reason for that is because when you hear somebody talk to you, put it this way, if you don't know this person well and this person doesn't know you well, and you could be at a party or something, it's always like the proverbial cocktail party, and there's some financial advisor there talking about stocks. And you could say, hey, what's a good tech stock for me to buy? And the financial advisor could say, stock XYZ. I love it. Great company. It's got this PE. It's got these multiples. It's going to go up. You know what? Without getting to know your investment objectives, like your risk tolerance, your financial goals, your time horizon, this person has no business recommending a stock to you. How could I possibly recommend something to you, okay, without knowing you personally? Now, some of you watching this, you know me, I know you, and I'm happy to sit down in private and discuss these things. But you certainly, when you're watching somebody on a screen or someone you don't know well and they don't know you well, giving tips might be good for somebody, these tips that they give, but it doesn't mean they're good for you. And what you should be interested in is, what are investment strategies or solutions that work for your situation? What are your goals? When do you want to retire? Are you 30 years old? Are you 70 years old? These questions need to be answered before somebody gives you a tip. So I say number two, investing tips, avoid them. Don't get into them. Don't even take them with a grain of salt. I don't think you should listen to investing tips. So if you're watching this live, thumbs up, some of these. I always love some of these. Okay. If you're watching this on Facebook, one of these, maybe a smiley face or the wow, the wow thing on Facebook. Okay. I'm going to check occasionally if anybody's out there. I hope you are taking a look at this. And if you're just joining us now in the replay, act as if you're, watching this in the live stream. Just, comment away, thumbs up, whatever. You have a question, go ahead and ask me, because if I miss the question in the live, I'll see it in the replay. And if you have a question in the replay or a comment, I definitely want to see that. I think most people watch these in the replay, so it's really for you. How about that? Okay, so let's get into number 3. Okay, we are right now in the Halloween edition of 5 mistakes. The only thing scarier than that mask that I was wearing when we first started this broadcast is making these mistakes. Okay, so let's go to number 3. Okay, number 3 here. Okay, is you don't know yourself. This kind of is a riff on number 2, because you need to have some responsibility in all this. Whether if you're a self-directed investor, if you are a do-it-yourself investor, or you're working with a financial advisor, or maybe both. Some people use a financial advisor and they have their own, account somewhere else that they manage themselves. A hybrid investor, let's call it. The important thing, though, is to know yourself. You can't just put that responsibility on someone else. You have to know how much risk you're comfortable taking. And if you don't know how much risk you're comfortable taking, then you have to probe and find out. So maybe invest a little bit just when you get started in investing, invest just a little bit. Or maybe you have to say, I'm an experienced investor, and you've been doing this for 50 years, and now you're older, or you're retired or ready to retire. You still have to know yourself. And maybe you have to say, hey, I'm not 40 anymore. I need to really batten down the hatches and lower my risk level, because I know that if I'm at a certain age, that I really can't afford to go through another severe bear market like the one we had in the year 2000 and the one we had in 2008, when the S&P 500 dipped about 50% or more. It could take a long time to recover from that. And it's not something that a retiree or someone close to retired wants to go through usually. That makes sense, I'm sure. So you have to know yourself. You have to know your risk tolerance, and you have to know what your goals are. You'll have more than one goal. Saying your financial goal is just retirement, that's not good enough, because retirement can last 15, 20, or 30 years, or even more. You could be retired for a long time. So maybe you need a goal that says, well, my retirement goal is kind of like in 3 parts. The first 10 years, the second 10 years, and knock on wood, the last 10 years. Because in each of those segments of your retirement, I see this. I have clients who are retired, and I have clients who are newly retired. I have clients who are retired for a long time. They don't always do the same things. Typically, as you get into your retirement, you start to slow down. Maybe you're not going to travel as much. Maybe you're not going to have 2 homes, whatever it is. You need to know these goals. So if you know these goals, once you know your time horizon, that helps dictate your risk tolerance. So the shorter the time horizon, the less risk you can afford to take, is typically the way that this works. I hope I'm talking loud enough, and I'm going to check my phone and see if anybody's out there. Okay. So we are talking live, and we are in this live presentation, and I hope you guys have some good questions for me. And if not, then I will, I'm going to keep going. Okay. So probably 5 o'clock is not the best time in the afternoon to make one of these live presentations. But you are watching a live presentation. Even if you're watching a replay, I'm doing this live. It's kind of weird going from making a lot of videos to going live, because I'm so used to hitting that pause button and starting over again and editing, and we don't get to do that here, okay? So we went over the first 3 big mistakes that I want to point out to you, okay? First big 3 mistakes of investing, all right? So the first one, which we went over, was lack of diversification. All right. The second one, okay, was don't go by investing tips. Investing tips, no good. Okay. No good. And number 3, okay, which we just went over, know yourself. You have to know your own risk tolerance. You have to know your own time horizon, your financial goals. These are the things that you need to learn about yourself. Listen, the most successful clients I have in terms of being really successful investors, I have some clients who they're so good at the stock market. They have such a wealth of knowledge. It's because they have learned over time what works for them. And the sooner you learn that, the better off you'll be. Okay. So let's take a look and go on to number 4. Number 4, you don't have a sell strategy. Okay. Think about that. We talk about buying, right? We talk about buying and investing in exchange traded funds and mutual funds and stocks and whatnot. So nobody's really talking about selling. Well, the idea is this. Think of it this way. I said this to a friend of mine, Phil, a while ago. The point of this exercise and you investing with me or with anyone, anywhere, is not to invest your money and pay, expense ratios and fees for the rest of your life. The idea is eventually you're going to take that money back. It's just hopeful you'll have a lot more money to take back in the future. And you want to use that money to pay for your lifestyle, to pay for your expenses, to spoil grandchildren, to send a child to college, okay? Or more than one child to college. So that's what that is all about. So a sell strategy means as you get older and closer to a goal, maybe you need to sell off some of your gains or take some profits or move some money out of your stock funds, okay? Because as you get older, your asset allocation, how much you have in stocks, bonds, and cash, that starts to become more conservative as you get older. So the bonds and cash part go up and your stock part goes down. If you're in individual stocks or even exchange traded funds that invest in stocks, maybe you need a sell strategy and when to sell those. Maybe you need to use a stop loss order or some kind of automated sell strategy because, some strategies, like some that I manage, stocks go up a certain amount of that position is taken off as a profit and reinvested elsewhere. And then another certain amount, a little more comes off. And until eventually we're left with a smaller position and we want to let that run. We want to hold on to that and make that a really long-term position as an example. Okay, this isn't a strategy that I use for everybody. And this is not meant to be personalized individual advice. I have to throw out all these disclaimers or else, my compliance friends, you're good people, my compliance friends, but I want to make sure that I could repost this video and keep it on LinkedIn. Okay. So I'm going to go into those disclaimers. Okay. If you're watching this in the replay, definitely leave a thumbs up, comment as if you're watching it live. It's more fun that way. And I would love to reply to you and go over some investing mistakes that you may have made. You can't cover every single mistake in a 15, 20-minute video. Okay. So number 5, okay, is overconfidence. Number 5. I recently wrote an article for CNBC. It's one of the things that I get to do. I get to write articles as a guest contributor to CNBC.com. And I wrote an article about a stock, a recent IPO that just took off like a rocket. And it was at the time one of the best performing IPOs around. It's called Beyond Meat. And the only thing scarier on Halloween than ghosts and goblins to me was actually the taste of the Beyond Meat, because after I had it, I was really no good. It wasn't what I expected. Just didn't like it. I tried the burgers. The sausage was okay, but that's because it's like loaded up with fennel and other spices, so that was okay. But I digress. Make Beyond Meat great again. Okay, so so the point I made in that is the worst thing that can happen to a novice investor is to score a home run right out of the gate. Just like, you invest in something and it goes up, because you could start to think making money in the stock market is easy. And that would be a mistake. That would mean a lot of overly proud. That would mean a lot of hubris. It would mean a lot of chutzpah if you think investing is easy. So the worst thing that can happen is you just buy some hot stock you see and it goes up and you start thinking, hey, I put some money into it. I doubled or tripled. Look, I think that's great and I want people to do well. I'm not saying that I want a novice investor to get kicked in the teeth when they start investing. But what I am, I'm going to say what I am hoping for, pleading for, is a realistic view of investing. Because, we've been in a bull market for a while now. I've been in this industry for almost 30 years. Early 2020 will be my 30th year in this business. So I've seen a lot of ups and downs. And basically, anybody who graduated college in the last 8 years, 9 years, 10 in the last 10 years hasn't seen a prolonged bear market where you see stocks get obliterated. And I'll give you a little story from the year 2000. There was a company called Lucent, which was $100 stock, one of the most widely held stocks in retail brokerage accounts, and the stock went down to $1. Okay, you until you've lived through it and go in day after day into work, and you hear in the news constantly that the news is always getting worse, that the world is falling apart. The stock market will, you start to think the stock market will never go up. That's when you need to be level-headed and realize that this too shall pass. But until you've lived through a bear market, it's easy to become overconfident. And that is something, to me, is one of the biggest killers of investment returns for investors, is when they think it's easy, they become overly concentrated in a stock or a sector, and that stock or sector goes down, it goes out of favor, and then people are scratching their heads thinking, how the heck could I have lost so much money? I thought I was so good at this. And then people just give up and they don't come back into the stock market. The stock market, for some people, it's a casino. But to me, it's not a casino. And it's not gambling. The difference between gambling and investing is, my analogy is this: the longer term you gamble, the lower your odds are of making money. And the longer term you invest, the higher your odds are of making money. There's a very big difference there. And I don't think it's so subtle. Yes, investing does involve a degree of risk, but just because it involves risk doesn't mean it's gambling. Gambling games are made by people who know that the numbers are stacked against the player. Investing is the complete opposite. Okay, so those are the 5 big mistakes that people make when they get started in investing. And I've seen experienced investors make the same mistakes as well, because people have a tendency to get complacent, or they're not paying attention and things are good and they don't bother looking, or they don't bother paying attention to things, and they fall back into old habits and they start making the same mistakes again. But the difference is, when people are older, that's when they can afford to make mistakes less, as opposed to being younger, when you can afford to make more investing mistakes and learn from your mistakes, because you've got so many years ahead of you to recover. So that's about it. Thank you so much for watching. Again, thumbs up if you're watching this in the replay. Let me know, and let me know where you're watching from. Let me know where you are located. I just enjoy that, seeing where people are coming from when they watch a LinkedIn Live. I certainly do that when I'm on somebody else's live. I like to say, hey, Mitch from New York, whatever. Yeah, that sounds kind of corny, but I do it anyway because I enjoy it. So I'm going to end this broadcast now. Thank you so much for watching. I'll be back next Thursday at 4:30. And that's about it. If you have any questions between now and next Thursday, or any topics you want me to cover, I'd love to hear about that too. I'm going to now end this broadcast. Thank you.